everybody, and welcome to the Sense of Security podcast. Today, I'm here with Interactive Brokers Jose Torres to discuss economic news in the markets. Welcome, Jose. How are you?
Mary, doing great. How are you?
I'm doing great too. So, lots going on. The Fed cut rates for the third time this year, but signaled a long pause. How should listeners read the one and done dot plot for 2026?
Yeah, listeners aren't really paying much attention to the one and done dot plot. In fact, our prediction market is expecting roughly 2 rate cuts next year.
Hmm.
And really, the main takeaway from yesterday's meeting and why the markets are so buoyant today on Thursday, December 11th, the day after the meeting, is that the Fed began talking about resuming its purchases of treasury securities at the short end of the curve to shore up liquidity conditions in the financial system. Now, that's terrific news for cyclically oriented, rate sensitive areas of the market. And that's why today, despite some negative AI news, Oracle missing on its cloud sales while also dialing up its artificial intelligence capital expenditure projects, despite those negativities, which investors are now worried that these firms are spending too much on AI with capital returns being questionable. Despite those concerns, Mary, still record highs today for the Dow Jones Industrial Average, as well as for the Russell 2000. Let's look at the S&P, not at an all-time high yet, but pretty close, only 0.2% away. Of course, that's just a modest green day, one more green day for the S&P. It's at 69.03, needs to get above 69.20 to make a new record. So we have a growing economy. The Fed acknowledged that the cycle is on solid footing because its projections were upgraded, its GDP forecasts, that is. And then, Mary, the inflation estimates were moved downward. Unemployment was neutral, but that was enough. Stronger GDP, softer inflation for market participants to get up and cheer alongside the Treasury bill purchases because a faster pace of economic growth paves the way for stronger corporate earnings going forward, while softening inflationary pressures opens the door to lower borrowing costs. So, of course, that's a great backdrop for investors. We want more profitability and we want cheaper borrowing costs because that can push up prices on the one hand due to earnings, and on the second hand, due to the potential for more valuation expansion. Because the higher interest rates go, the harder it is to expand valuations. So, really, a really great day, a really big surprise. Fed's going to start injecting roughly $40 billion per month into the treasury market. Why are they doing this? Because recently we've seen banks, and we spoke actually about this in one of our previous Sense of Security podcasts, maybe the last one or the second to last one that we've done prior to this one on December 11th. And we've seen that the facilities of the Fed has shifted from the reverse repo facility, an environment where banks have a lot of cash and not that many securities, to the opposite. Now they're using the repo facility, meaning that they have securities, but they don't have that much cash. So what happens is you start seeing usage in that facility. And when there's more demand for that facility, all of a sudden interest rates, short-term interest rates start to increase and threaten to move out of the Fed's range. The Fed's range right now is 3.5 to 3.75%. Last time we saw rates explode to the upside was back in 2018, 2019. We saw some episodes there near quarter ends, similar time to where we are now towards year end, where banks have wanted to hold on to their cash. So then liquidity was weakening in the system, softening. So now the Fed stepping in and purchasing a lot of those securities, it really allows bank reserves to be alleviated and allows proper function and smooth function, rather, across the banking system, which of course is great for the stock market.
So Powell says job growth may be overestimated by 60,000 or so jobs per month, while initial claims jumped to 236,000. How worried should listeners be about the labor market, if at all?
You know what? I'm not that worried. Firms are doing well. looking like a reacceleration in the economy. We got the government reopened after the longest shutdown in history. That's serving to be a cyclical tailwind in the short run. Also, President Trump's signature taxation package passed in 2025 is going to serve to boost earnings and economic performance in 2026. Corporates are going to benefit from, of course, softer taxation charges. And then also, you have that depreciation write off where you can write off 100% of capital expenditures in the first year. That's also going to be a benefit that can help support more share buyback programs, additional dividends, as well as other kinds of investments. So, why would employers really trim labor in that kind of landscape? Of course, we're getting conflicting information across different sources. Still in a low fire environment. But why are we in a low hire environment? We don't have the immigrants because the immigrants, when you have an open border, those folks come in and the vast majority of them want to work right away to improve their economic fortunes as well as to send money back home. They may have parents, their wives, husbands, children, grandchildren, etc. So you don't have that strong support to the labor market. You don't have as many people. So you have a labor supply issue. And then you also have a demand issue. But the demand issue is not that significant. And just that when you pair it with the supply issue, it really makes the labor market confusing. And you have the AI adoption that's really containing early level career entrants. So folks that just graduated college, that unemployment rate is particularly high. And then rates have been too high for some of those areas of the economy that really need softer borrowing costs to begin to expand headcounts. Namely, we're talking about real estate / construction, manufacturing, and small business. Pleased to say, though, this week, we got to forget about unemployment claims because during the holidays, those numbers are crazy. So, yeah, they rose up to 236 in this report. But the last report, Mary, we saw the softest number in 38 months. And now, next week, we have the highest number in 13 weeks. Continuing claims this morning, the lowest number in 7 months. Got to go back to April, which is a shocker. So the holidays are weird for unemployment claims. But other data points that came out, ADP on Tuesday, that new weekly indicator, terrific to look at. I'm fascinated by it. Very happy that it's being made available. So a little confusing on the schedule. It's every week, but on the weeks that the ADP monthly report comes out, there will be no weekly report on Tuesday. Usually the ADP monthly report comes out around the first week of the month, right before the BLS Jobs Friday, which could fall anywhere from the first, second day of the month up to 8th or 9th day, first 10 days, generally speaking. Those numbers were good earlier this week. That was December 9th. That same day, we also got small business optimism ticked up, stronger sales expectations, also heavier hiring intentions. Small businesses are looking to pick up more workers. However, one of their biggest issues is labor quality. They find that it's hard for them to put out a job posting and acquire the candidates that they need to fulfill the specific roles. And then also you had JOLTS, the job openings and labor turnover survey. We got numbers from September and October were delayed due to the shutdown. Big beats, Mary, big beats showing that labor demand is still robust, roughly 7.6 million, 7.7 million off of the top of my head. Big beats. Wall Street was expecting around 7.2 million. So it's showing you that, employers still want labor. They have specific roles. They don't just want to take anybody. They need to have workers that can do what they need. And we've had that mismatch in the labor market, ladies and gentlemen, Mary. We've had that mismatch for a long time. Back when I was at the Bureau of Labor Statistics in 2016, we used to talk about it, how we had during that time, 6 million unemployed folks or so and 6 million job openings. And the Secretary of Labor and the president would always talk about how come we can't just get those 6 million people that are unemployed on the one hand and the 6 million for hire signs on the other hand? Why can't we just put them together? Just so happens that the folks that are unemployed can't do those jobs because they're not skilled for it.
I'm going to coin a new term. Jolly Jose Torres.
Do I still the
You're
holidays?
jolly. It's like right before the holidays. I always feel beat when I talk to you about all the awesome things with the economy. Okay, so mortgage rates dipped to the lowest of the year right after the Fed cut. What does that mean for prospective home buyers in 2026?
We're in a buyer's market, Mary. Sellers are out there. They're looking to transact at high prices. And the reality is that because rates have been so high, it's the affordability picture has been dampened. So there's really a wide gap between the sellers and the buyers. At the same time, however, homeowners aren't in a rush to sell. They need to live somewhere. We're seeing a lot of behaviors where folks are listing for 2, 3 months and they're just taking the house off of the market because they're not getting the offers that they'd like. Part of that is you have a high degree of equity build up in the houses. You're not in a 2008 kind of situation where a lot of people were underwater, had limited numbers of equity, 5% equity, 10% equity. You have a lot of people, 50% equity, 75% equity, cash buyers, 100% equity. So, these folks, they don't want to take a 200,000, 100,000, 50,000, $300,000 haircut on the price that they paid. They'd rather just wait. And over time, home prices go up. But back to the immigration story. Rents are softening, home prices are softening. You don't have those immigrants come in. They want to rent places. That puts upward pressure on rents. That also drives valuations north, right? Because a home's price is highly influenced by how high you could rent that property for. So because we're seeing softening rents, which by the way, Chair Powell mentioned yesterday in the FOMC, the Powell presser, because you have those softening rents, you're also seeing softening price action. But there's a lack of price discovery because, like I said, the sellers are not in a rush. It's not like the stock market where you have price discovery every second, tick by tick. These people can say, oh, really? You don't want to buy at this price? Then I'm not selling and I'm just going to wait. There's a 50% chance, according to our prediction markets, that the Democrats get back in the White House in the 2028 election. So a term would start in 2029. There's also a very high chance the Democrats are going to win the midterms in the 2026 and this November coming up, 11 months. A lot of those home sellers are also waiting because there's an expectation that once the Democrats become more influential in Washington after some election wins, then all of a sudden the border is going to open up and then we're going to have immigrants starting to flow again. And then that should support home valuations. While at the same time, of course, rates are coming down.
Interesting. So, last question. How's holiday spending going? What are you seeing?
Holiday spending's been pretty strong. We heard from American Express, strong numbers. Black Friday was also robust. So consumers are feeling bad. The sentiment numbers have been poor. In America, this is the culture, okay? You're feeling great. Go out and spend. You're feeling neutral. Go out and spend. You're feeling bad. Mary, what do?
Shop. Shop therapy.
Go. You got to
That's
go out
it.
and spend.
That's
So
it. Looking for those deals.
absolutely, absolutely. So folks are out there spending on services, on goods, definitely more of an uneven kind of situation where the wealthier households are increasingly taking up a greater share of consumption and keeping the economy afloat. Of course, the middle class cohorts and the lower class cohorts are they're under a little more pressure or a lot more pressure when you consider that they don't have as much exposure to real estate markets. For example, they don't own multiple homes in most cases. They don't have vast investment portfolios in most cases. And we know that from the pandemic to now, we've had inflation shoot up and asset prices are through the roof, okay? The S&P 500 is up 17% year to date, following back-to-back years of returns north of 20%. So you have this environment where the 401k people, the people with the investment accounts are doing a lot of the spending because they look at their portfolios and hip, hip, hooray. But if you're expecting your paycheck to go up 25% or 30%, it doesn't really work that way. Folks that are more levered to the labor market rather than the capital markets, they're facing that struggle of having to keep up with higher prices, having to manage loftier interest rates. And that's pressuring them a little bit because they're having to choose a lot between staples and discretionary things.
Well, in other words, we need the very wealthy to go out there and shop, right?
We
They
do,
need
and they
to get
have
through.
been.
They need to do their part and get out
They
there.
have been, and I think in 2026, how much I think we're gonna see a flip. I think that the gap is gonna start to narrow. I think capital markets will still do well, but I think it's gonna be a more broader recovery in the 2026. And I think that who's gonna lead the markets higher is gonna be the small caps, the smaller companies that are gonna be that are more indicative of the actual economy. Because for the last few years, we've had a market and an economy that has been different worlds, really. When you consider the AI theme and how much the AI and the technology, the modern technology, how much that's driven equity price appreciation versus people on the street and how much they actually understand or use or have a relationship with AI at all. Very bifurcated and different. Those companies have been doing terrific. But then the companies that people know, regular people on the street, right? The Home Depots, the Targets, a lot of the retailers, a lot of the fast casual restaurants, okay? Sweet Green, Cava, Chipotle, etc. McDonald's. That's not fast casual, but you get the gist, folks. Those firms that are more levered and are more exposed to regular people in society, right? They're seeing, wow, people are really pulling back. They don't want to pay the $25 for the salad anymore. Maybe they only want to do it once or twice a week. They don't want to do it 7 days a week or 5 days a week. So they're really paring back. Those firms are feeling the real pressures of affordability in the US. But the AI companies, they're building these huge data centers and they're automating a lot of things and they're using the modern technology to progress their operations and to expand into different verticals. So they're not as exposed to the quintessential American man or woman.
That is for sure. All right, Jose Torres of Interactive Brokers. Thank you so much for your insights. Really appreciate it. And
My
happy
pleasure,
holiday.
Mary.
We'll
To
see if we can get
continuing
one more in before the end of the year. And definitely, it should be a spicy 2026, I hope. Anyway, at the end of the day, go Mets, right?
Oh yeah, I'm a Queens boy. You see me wearing the blue and the orange. It's not baseball season, but it just so happens that this is the combination that I chose today, folks. So let's go Mets.
I love it. All right. Thank you, everybody.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Canada Inc., Interactive Brokers Hong Kong Limited, Interactive Brokers Ireland Limited, and Interactive Brokers Singapore PT Limited. Forecast contracts on U.S. election results are only available to eligible U.S. residents. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC risk disclosure. For a copy, visit our warnings and disclosures page. Displayed outcome information is based on current market sentiment from ForecastX LLC, an affiliate of IB LLC. Current market sentiment for contracts may be viewed at ForecastX at forecasttrader.interactivebrokers.com/en/home.php. Note: real-time market sentiment updates are only active during exchange open trading hours. Updates to current market sentiment for overnight activity will be reflected at the open on the next trading day. This information is not intended by IBKR as an opinion or likelihood of a potential outcome.
This is commentary on economic, political, and/or market conditions within the meaning of CFTC Regulation 1.71 and is not meant to provide sufficient information upon which to base a decision to enter into a derivatives transaction.